On January 18, 1863, Khedive Ismail Pasha delivered his first address as ruler of Egypt. He spoke about the importance of fiscal responsibility. He promised, in his own words, that the basis of his administration would be system and economy in finance. He resolved to set specific budget allocations that he would, he said, never exceed. He started borrowing the following year. By 1876, 13 years after that speech, Egypt's national debt had risen from approximately £3 million to £94 million. Debt service, just the annual interest payments to European creditors, was consuming 80% of Egypt's government revenue. The land tax on Egyptian farmers had been increased fourfold. Every major asset the Egyptian state possessed had been pledged as collateral to foreign bankers, and a commission representing British, French, Austrian, and Italian creditors had taken effective control of Egypt's government finances, deciding which revenues went to which purposes before the Egyptian government itself could touch them. 6 years later, Britain landed an army on Egyptian soil. Here is what the conventional narrative does with this story. It talks about imperial ambition. It talks about the strategic importance of the Suez Canal. It talks about Khedive Ismail's personal extravagance, the opera houses, the palaces, the legendary inauguration party. And all of those things are real. They happened. But the conventional narrative misses the mechanism. It treats the outcome, British occupation, as something that was done to Egypt by external force. And that is not quite accurate. What this video is going to do is treat Egypt between 1863 and 1882 as a corporate death timeline, because what happened to Egypt in those 19 years follows, almost exactly, the same pattern as the corporate collapses we've studied in this series. The promising entity with real assets and real revenues. The access to capital at terms that seem attractive until you read the fine print. The borrowing against optimistic projections. The debt service that gradually crowds out every other use of revenue. The asset sales to cover short-term obligations. The creditor takeover. The end of independent management. Egypt wasn't conquered by Britain. Egypt was acquired by Britain after Egypt's creditors had already done the essential work of stripping it of its financial sovereignty. The British Army in 1882 didn't arrive to take something that was still Egyptian. It arrived to secure something that European finance had already taken, and that an Egyptian nationalist uprising was threatening to recover. The 5 decisions in this timeline are not decisions made by villains. Khedive Ismail was not stupid. He was ambitious, educated, visionary, a man who genuinely wanted to make Egypt into a modern state. But he made 5 financial decisions, or found himself trapped inside 5 structural conditions that turned his development ambitions into a debt engine that consumed Egypt's sovereignty. Let's trace them, because the pattern they create is not unique to 1860s Egypt. It is one of the oldest patterns in the history of money. To understand what Khedive Ismail walked into in 1863, you need to understand 2 things about Egypt at that moment. The first is the opportunity. Egypt in 1863 was genuinely positioned for development. Muhammad Ali, Ismail's grandfather and the founder of modern Egypt, had spent the first half of the 19th century building state infrastructure, factories, irrigation networks, a modern army, and administrative system. This development had been financed internally from Egyptian resources without foreign debt. Egypt had, before the era of European finance, demonstrated that it could build state capacity on its own terms. By 1863, however, Egypt was deeply integrated into the global cotton economy. The American Civil War had begun in 1861. The Union blockade of Confederate ports cut off the flow of American cotton to European textile mills, particularly in Lancashire, England, and Lyon, France. Global cotton prices surged. Egypt, as a cotton producer, experienced an extraordinary windfall. Cotton prices rose by as much as 400% during the war years. Egyptian revenues expanded dramatically. The country looked, from the outside and from the inside, like a development story in progress. The second thing you need to understand is the trap embedded in that opportunity. Egypt's cotton boom was temporary. Everyone rational understood this. The moment the American Civil War ended, as it did in 1865, Southern cotton would return to the global market. Prices would fall. Egyptian revenues would contract. Any borrowing built on projections of sustained cotton boom revenues was borrowing built on sand. Ismail understood this intellectually, at some level, but the combination of available capital and visible opportunity was overwhelming. European bankers, British, French, and a constellation of smaller houses, were aggressively seeking sovereign borrowers in the developing world in the 1860s. Capital was abundant in Europe after decades of industrial expansion. Yields on safe domestic investments were modest. Sovereign bonds, issued by developing world governments, offered attractive returns. The risk, from the banker's perspective, was not catastrophic. Sovereign bonds could be restructured, renegotiated, or, as events would prove, enforced through political and ultimately military pressure on the borrowing government. The lenders had no real downside. The borrower bore all the risk. Into this environment, Ismail brought a modernization agenda that was genuinely ambitious and, in many respects, genuinely valuable. He expanded the railway network. He added thousands of miles of irrigation canals. He built telegraphs, lighthouses, schools, and hospitals. He modernized Cairo, physically redesigning the city in the European style, complete with broad boulevards and grand public buildings. He built a steam fleet that was, by some measures, technically superior to France's. He expanded Egypt's territory southward into Sudan and eastward toward the Horn of Africa. Each of these projects was real. The development they created was real. But the financial architecture on which they were built was something else entirely. Here are the 5 decisions, or 5 structural traps, that turned Egypt's development decade into its debt-death spiral. Decision number 1. The cotton boom that masked the structural problem. The first decision, or more precisely, the first structural failure, was borrowing as if the cotton boom would last. Between 1861 and 1865, Egyptian cotton revenues surged. The government's income grew substantially, and Ismail used that income as collateral for borrowing, projecting that elevated cotton revenues would continue, which meant Egypt could service larger and larger debts. This is a pattern with a name in modern finance. It's called pro-cyclical borrowing. You borrow heavily when times are good, against projections that good times will continue. And your debt service capacity is then exposed the moment conditions deteriorate. The cycle of building debt that looks sustainable in boom conditions and becomes catastrophic the moment those conditions reverse. The American Civil War ended in April 1865. Within months, Southern cotton was flowing back to European markets. Cotton prices began their decline. Egyptian export revenues, the primary source of debt service, contracted sharply, but Egypt's debt obligations did not contract with them. The interest payments were fixed. The principal repayments were fixed. The revenue stream that was supposed to service them was falling. Ismail's response was logical, and exactly wrong. He borrowed more. To service existing debts whose revenue base had shrunk, he took new loans, at whatever terms European bankers would offer. Those terms, as we will see, were designed to generate maximum income for the lenders, regardless of the actual financial condition of the borrower. The cotton boom had created an illusion of fiscal capacity that masked Egypt's actual structural position. A developing world agricultural economy, heavily dependent on a single export commodity, borrowing in the currency of industrial creditors, with no control over the global commodity prices on which its debt service depended. The moment the commodity price moved, the illusion collapsed. But by then, the debt was real. Decision number 2. The loan architecture that made default inevitable. The second decision, and this is the one that transforms a development challenge into an absolute trap, was the structure of the loans themselves. Egyptian sovereign bonds in the 1860s and 1870s were not issued at face value. This is the detail that makes everything else comprehensible, and it is the detail that most narratives omit. When the European banking houses, Fruhling and Goshen, Oppenheim, Société Générale, the Imperial Ottoman Bank, and others, issued bonds on Egypt's behalf, they sold those bonds to investors at a discount to the nominal value. The discount represented the bank's profit and the investor's compensation for perceived risk. Egypt, however, owed the full nominal value plus interest, calculated on the nominal amount, not the discounted amount actually received. Let the specific numbers make this concrete, because the numbers are extraordinary. In 1862, Egyptian bonds with a nominal value of £3.3 million were sold at 83% of face value. Egypt received approximately £2.5 million in cash before fees. Over 30 years, the total repayment obligation, principal depreciation plus compound interest, reached nearly £8 million. Egypt borrowed £2.5 million and owed £8 million. That is a real interest rate that would be recognized today as predatory by any reasonable standard. The 1873 loan is even more striking. Bonds with a nominal value of £32 million were sold at a 30% discount. Egypt received less than £20 million in cash. The total repayment obligation over 30 years, including principal and compound interest at 11% real, was approximately £77 million. Egypt received less than £20 million and owed £77 million. Across multiple loans between 1862 and 1873, the pattern repeated. By 1876, Egypt's nominal external debt was £94 million, but the actual cash Egypt had received from those loans, before fees, discounts, and commissions were deducted, was a fraction of that figure. The gap between what Egypt received and what it owed was not a consequence of mismanagement. It was baked into the loan structure by design. There is another dimension to this that is rarely discussed. The 1873 loan, Egypt's largest, was secured against the revenues of Egypt's railways, its personal and indirect taxes, its salt tax, and several other revenue streams. This meant that by 1873, all of Egypt's major government revenue sources had been pledged as collateral to foreign creditors. Egypt had no unencumbered revenue left. Every pound that came into the government's accounts was already earmarked for debt service before the government could spend a shilling on anything else. Egypt had borrowed itself into a position where it could not invest in its own development because every investable resource had been committed to servicing previous borrowing. The creditors had no interest in changing this structure. It was working exactly as intended from their perspective. Compound interest was accruing. Collateral was in place. The risk was borne entirely by Egypt. Decision number 3. The mega-project spending that enriched European contractors. The third decision, and this one sits at the intersection of Ismail's genuine ambitions and the structural exploitation available to European contractors, was the infrastructure spending itself. Egypt did build real things with its borrowed money. The railways, the irrigation canals, the telegraph network, the modernized ports. These were genuine infrastructure projects with genuine developmental value. Egypt added 8,400 miles of irrigation canals under Ismail. It built 910 miles of new railways. It upgraded the port at Alexandria and constructed a modern fleet. But the prices Egypt paid for this construction bear examination. The documented record is damning. Egypt paid the equivalent of 325 million francs for railways that cost 75 million francs to build, a markup of more than 300%. The Treasury paid a European building firm over £2.5 million for the port of Alexandria, when the actual construction cost was approximately $1.5 million. The Khedive's personal estates, which had been developed as sugar plantations, were built at costs that were systematically inflated by the European contractors who provided the labor, materials, and engineering. This was not coincidental. European contractors operating in developing world markets in the 19th century operated in a context where the borrower had no competitive market to appeal to, no independent cost auditing, and no alternative suppliers. The contractors set their prices knowing that Egypt was borrowing the money to pay them, meaning Egypt would pay not just the inflated construction cost, but compound interest on that inflated cost for decades. The infrastructure was real, the development was real, but the financial cost of that development, because it was systematically inflated and because it was financed through the compound interest loan structures we just described, was 2, 3, sometimes 4 times what comparable infrastructure was costing elsewhere. Ismail was building Egypt's future. He was doing it with money he had borrowed at effective interest rates approaching 11% to pay contractors who were charging him 300% above construction cost. The financial mathematics of this situation had only one possible destination. Decision number 4. The internal squeeze. Making Egyptian farmers pay the bill. The fourth decision The one that transferred the cost of all of this onto ordinary Egyptians was what happened to taxation as the debt spiral deepened. By the early 1870s, Ismail's options for raising revenue to service his accumulating debt were narrowing rapidly. He had already pledged most of his major external revenue streams to foreign creditors. He turned to internal extraction. The land tax, the primary tax burden on Egyptian farmers, was increased fourfold between the beginning of Ismail's reign and 1875. It rose from 40 to 160 piastres per feddan of agricultural land. Egypt's budget income grew from £2 million in 1861 to £10.5 million in 1875, a genuine increase. But 80% of that expanded revenue was committed to debt service before any of it could be used for Egyptian purposes. Ismail also created new internal borrowing mechanisms. In 1871, he introduced the mukabala, a scheme under which landowners who prepaid 6 years of land taxes up front over a 12-year period would receive a permanent reduction of 50% in their future land tax obligations. The wealthy landowners who could afford to participate got a long-term tax benefit. The government got immediate cash, approximately £7 to £8 million over the period, which it used to service its foreign debt. In 1874, facing continued shortfalls, the government introduced the ruznameh, a second compulsory internal loan. Despite being made compulsory, it raised less than £2 million. The Egyptian population's capacity to provide additional revenue to service European debt had reached its limit. The land tax increases, the compulsory internal loans, the progressive mortgaging of future revenue for present cash, all of it fell ultimately on the Egyptian agricultural population. The farmers who grew the cotton that had temporarily made Egypt look wealthy were the ones paying, through quadrupled land taxes, the interest on loans that were enriching European bankers. The interest payments on Egypt's foreign debt were approximately £8 million annually by 1875. Egypt's government collected approximately £10.5 million in total revenue. After debt service, there was £2.5 million left to run a country. This is not a metaphor. This is the arithmetic of colonial debt as it operated on the ground. Decision number 5. The creditors stop asking and start taking. The fifth decision, the final movement in this corporate death timeline, is the moment the creditors stopped accepting Egypt's promises and started institutionalizing their control. In 1875, as we traced in the previous video, Ismail sold Egypt's Suez Canal shares to Britain for £3.97 million to meet immediate debt deadlines. The sale provided temporary relief but did not address the structural problem. In April 1876, unable to meet further obligations, Ismail formally suspended payment of his treasury bills. Egypt had defaulted. The creditors' response was swift and systematic. In May 1876, the Caisse de la Dette Publique was established, a formal international commission representing British, French, Austrian, and Italian creditor interests. Its function was specific and intrusive: to collect designated Egyptian government revenues before the Egyptian government itself could access them, and to disperse those revenues to bondholders as debt service. The case did not advise Egypt on its finances. It stood between Egypt and its own revenue stream and took what was owed before Egypt could spend anything else. The case was initially somewhat restrained, but in 1878, as Egypt's financial position continued to deteriorate, compounded by a catastrophically poor Nile harvest and the Russo-Turkish War of 1877 to 1878, which destabilized regional credit markets further, Britain and France moved to more direct control. They appointed their own representatives to Ismail's cabinet. A British subject became Egypt's Minister of Finance. A French national took the portfolio for public works. Egypt had a European cabinet, a cabinet appointed not by its ruler, but by its creditors. Ismail resisted. He maneuvered politically, attempted to rally nationalist support, tried to assert the Egyptian government's prerogatives against the Anglo-French commissioners. The response of Britain and France, working through the Ottoman Sultan, who was nominally Egypt's suzerain, was to depose him. In June 1879, Ismail was removed from power and replaced with his son, Tawfiq, who was more compliant with European financial direction. Ismail left Egypt never to return. He died in 1895 in Istanbul, a man who had borrowed his country into captivity and was exiled when he tried to resist the consequences. Tawfiq inherited not just his father's throne, but his father's debt. The dual control, the Anglo-French financial oversight regime, continued. But dual control without military enforcement was fragile. When an Egyptian nationalist movement emerged in 1881 under Colonel Ahmad Urabi, a movement driven precisely by the economic distress that the debt burden had created and by the loss of Egyptian sovereignty to European creditors, the system was threatened. Urabi's movement was not primarily about religion or military grievance. It was, at its core, a rebellion against the fiscal extraction that European debt had imposed on Egypt. It was Egyptians demanding that Egyptian revenue be spent on Egyptian purposes rather than service to European bondholders. Britain's response in September 1882 was to bombard Alexandria in land and army. The occupation that followed lasted until 1956. Lord Evelyn Baring, later Lord Cromer, arrived as British agent and consul general in 1883 with a single overriding mandate: ensure the debt was serviced. The Caisse de la Dette Publique remained in operation. Egyptian revenues were allocated first to creditors, second to the Egyptian state. Under Cromer's management, Egypt eventually ran budget surpluses, but those surpluses went primarily to retiring the debt that had funded Ismail's modernization and European contractors' profits. The death timeline was complete. The entity, Khedival Egypt, had been absorbed by its creditors. Section 4. Contrarian Lesson. Here is the contrarian lesson of this timeline, and it is not the lesson most histories draw. The standard account blames Ismail, his extravagance, his vanity, his inability to distinguish development from spending. And some of that is fair. The inauguration party was reckless. The personal estates, the palaces, the bribes to the Ottoman Sultan, real money wasted. But the forensic accounting of Egypt's debt tells a different story. The 1862 loan. Egypt received £2.5 million and owed £8 million over 30 years. The 1873 loan. Egypt received under £20 million and owed £77 million. Across every major borrowing, Egypt received a fraction of its nominal obligation. The gap between what Egypt received and what Egypt owed was not created by extravagance. It was built into the loan structure before Ismail signed anything. A company that takes on liabilities 3 times, 4 times, 5 times larger than the actual cash it receives cannot be blamed entirely for collapsing. The blame for the structural impossibility of Egypt's debt belongs also to the banking houses that designed those structures and sold them to a developing nation borrower they knew had no leverage to negotiate better terms. And here is where the corporate parallel is most precise. This is not a 19th century story. The same mechanics, discounted issuance, compounding interest on nominal values, collateralization of future revenue, forced austerity administered by creditor-controlled commissions, appear in modern sovereign debt crises, from Argentina to Greece to Zambia. The names change. The case becomes the IMF. Lord Cromer becomes a structural adjustment program. The debt service ratio that crowds out every domestic spending priority is the same ratio. Egypt in 1876 is the template. Its corporate death timeline is a case study that every sovereign borrower should read before signing. Because the lesson is not, don't borrow. The lesson is, understand what you're actually borrowing, at what true cost, and who holds your collateral when you can't pay. Egypt didn't understand, and it cost them 70 years. Now here is the thread connecting everything in this arc. The British railways in India were built on guaranteed returns, paid from Indian taxes, that transferred wealth from one of the world's poorest populations to London investors. The East India Company governed a subcontinent by turning its tax revenues into shareholder dividends. And Egypt borrowed itself into colonization through loan structures that were mathematically impossible to service. 3 different mechanisms, 1 outcome. Financial architecture designed to move wealth from the periphery to the center, from the governed to the financier, from the raw material producer to the industrial creditor. In tomorrow's arc, we move west, to Egypt's neighbor and the other major power that found itself drawn into the Suez question. We're going to watch a nation make an almost identical series of financial mistakes on an even shorter timeline, in a crisis that started with a military gamble and ended with a withdrawal so humiliating it effectively ended Britain's role as a global superpower. The 1956 Suez Crisis. Britain bet its entire oil supply on a 6-day war. It lost. That's next.